The tax paid by beneficiaries of a super balance can easily be in the tens of thousands. It mostly depends on who it's paid to, and your choices are limited. Now, most of this video focuses on the different taxes payable on super death benefit payments, but I'll also be sharing a few tips on how you can arrange your super so that your loved ones pay no tax when they receive your super. Hi, I'm Chris Trano, the founder of Super Guy, the place where Australians go to maximise their super and build their own retirement plan. Superguy.com.au is your one-stop shop for all things superannuation and retirement. Sign up for my newsletter to get even more exclusive tips and advice. Also, help this channel by clicking the subscribe button and giving this video a thumbs up. It would mean a lot. Alright, let's get started. Today we're going to discuss tax on lump sum super death benefit payments. So what is a superannuation death benefit? Well, basically when you pass away, your superannuation needs to be paid to someone, or some people, because it can be paid to more than one person. Your super can be paid as a lump sum or in some instances as an income stream, but today we're focusing just on lump sum payments only. So who can lump sum super death benefits be paid to? Well, your super can't be paid to just anyone when you pass away, and your will does not decide who it's paid to either. When you pass away, a super lump sum can only be paid to someone who meets the definition of a superannuation dependent, which includes a spouse or de facto spouse, your child of any age, and or someone that a person that you had an independency relationship with at the time of your death, which is basically someone you had a close personal relationship with, lived with, and one or both of you provided the other with financial and domestic support and personal care. Your super can also be paid to your legal personal representative, and this is the person who's responsible for distributing your estate to your beneficiaries. And in this case, your super will then be paid in accordance with your will. So now that we know who can receive your lump sum super death benefit payment, how will it be taxed? Okay, so the tax on a death benefit is based on two factors. One, who the recipient of the death benefit is, and two, the tax components of the death benefit. Most super balances will consist of two tax components, the tax-free component and the taxable components. However, it is possible for a super death benefit to also include a taxable untaxed component, especially if life insurance is held within the super account. But for now, we're going to stick with the tax-free and taxable components only, and I'll address the untaxed components shortly. So we know the type of people who can receive death benefits. These are known as superannuation dependents, as shown on the previous slide. But who will receive the who will receive the death benefit tax-free, and who will need to pay tax? Well, similar to superannuation dependents, but different, we also have tax dependents. A person can be a superannuation dependent but not be a tax dependent, and whether or not a person is a tax dependent or not will determine whether or not they pay tax on receipt of a death benefit and how much tax. So a tax dependent includes a spouse or de facto spouse, a former spouse or de facto spouse, and this includes any sex, by the way, a child under the age of 18, a person you had an independency relationship with at the time of your death, and any other person dependent on you at the time of your death. Now, you'll notice that this tax-dependent definition is very similar to the definition of a superannuation dependent. However, you may have spotted the main difference, I'd say, is that a superannuation dependent includes a child of any age, whereas a tax dependent only includes a child under 18. In saying that if your child over 18 is dependent on you at the time of death, then they are a tax dependent, so that could work. For example, a child over 18 who is financially dependent on you at the time of your death would probably be considered a tax dependent. So let's take a look at a visual. Remember I was talking about tax-free components and taxable components. Well, the tax-free component portion of a death benefit will always be received completely tax-free regardless of whether the recipient is a tax dependent or not. No tax will be payable on this portion. The taxable component of a lump sum death benefit is also received completely tax-free when paid to a tax dependent, but when paid to a non-tax dependent, for example a child over the age of 18, then tax of 15% plus Medicare levy is deducted from the death benefit. Let's take a look at an example. Let's say Irene, who is 84, passes away with total remaining super balance of $400,000. And just to be clear, when I refer to a super balance, this can either be an accumulation balance or a pension balance, because both can be paid out as a lump sum death benefit, and both are treated the same. Unless your pension is a reversionary pension, but we're not going to get into that in this video. So Irene is 84, she passes away. Her $400,000 balance consists of $200,000 taxable component and let's say $200,000 tax-free component. Irene's husband Alf survives her and is the sole beneficiary of her super. Now, because Alf is a spouse of Irene and therefore considered a tax dependent, no death benefits tax is deducted from the lump sum death benefit payment, even though part of the balance includes taxable components. However, what if instead Alf had predeceased Irene and Irene has now nominated her daughter Sally as the beneficiary? And these days Sally is 55, living in the outer suburbs of Sydney with her new boyfriend Stavros. Now, despite Sally being a child of Irene's, she's not considered a tax dependent because she's over 18. Therefore, she will not receive the death benefit tax-free. So of the $400,000 balance, she will receive the $200,000 tax-free component tax-free because that is always received tax-free, but the $200,000 taxable component portion will be taxed at 15% plus Medicare levy. Therefore, Sally will pay death benefits tax of $34,000 on the $400,000 death benefit and receive the net amount of $366,000. Does that make sense? Now, just one more thing before we go. So far we have addressed the taxable component and the tax-free component, but remember I also mentioned that your super balance could include a taxable untaxed component, especially if life insurance proceeds are paid into your account when you die. Well, if your balance does include a taxable untaxed component, death benefits tax of 30% will be payable on this portion by non-dependents, whereas a tax dependent will receive this portion tax-free. So basically, a tax dependent of the deceased will never pay any tax on a lump sum death benefit. A non-tax dependent, such as an adult child, will receive the tax-free portion tax-free, will pay 15% plus Medicare on the taxable portion, and will pay 30% plus Medicare on the taxable untaxed portion. To find out the tax components of your balance, you can simply contact your superannuation fund. It will generally not be shown on your superannuation statement. You will need to call them and ask them for the tax components of your balance. And importantly, these tax components will change every single day based on contributions, withdrawals, any investment earnings. And so while you can calculate what the potential death benefits tax would be today, this figure will change every day as your balance changes. If you have a self-managed super fund, you should be able to see the tax components of your SMSF financials on your SMSF financial statements, or by simply contacting the administrator or the accountant of your SMSF. You might also want to consider how these taxes would apply for estate planning purposes. So, for instance, if you have more than one person that you intend on leaving your estate and superannuation to, you might consider devising a plan whereby only tax dependents receive superannuation proceeds, so as to pay no tax, and then offset any other amounts received through your estate by the amounts they received from super, if that makes sense. Either way, this is something you should be discussing with your estate planning specialist solicitor. You should also look into a recontribution strategy to see how that can reduce potential death benefits tax by converting taxable components to tax-free components. Now, this can get very tricky, so you should definitely seek personal advice. Check out some of my other videos which give specific tips on how death benefits tax can be reduced or even eliminated. Remember, by clicking that subscribe button and hitting the thumbs up, you're helping this channel grow. Thanks for watching. I'll see you on the next one.